Okay, so let's speak about W and informations on the daily time frame. So what we are looking for on the daily time frame when we have a W or information. Now the first thing you need to know, W and informations on the weekly time frame we had already defined the rules for them. Now on the for the weekly time frame we had already defined the rules for them, and we had 3 rules. Now for the daily time frame W and informations, however, we will have different rules, but the first rule will be obviously the same. We need to have a W or an information, so that rule will be exactly the same. Then the second rule is that we basically if we have a big pattern, then it will be easy to basically take the trade, because we will have good risk to rewards. But every time we have a small pattern, we need to identify on the higher time frame which is the direction. So are we getting any of our strategies satisfied on higher time frames that give us the direction? Because if, for example, we have a big W formation, pay particular attention to what I'm saying now. If you have a W formation on the weekly time frame, then obviously you're expecting a push to the neckline. But if on the daily time frame, inside of that same leg, so basically you have a W formation on the weekly time frame, and here on the daily time frame, so this is the weekly, but on the daily, here you are getting an information. So obviously what you will do? Nothing. You are overall still short. So what happens is that the information on the daily time frame in that particular situation becomes the ICI strategy. If you have already studied it, you will understand immediately. If not, you will understand later, because basically that becomes a completely different strategy, the ICI strategy that is lining up with the W formation from the weekly. So again, we will be actually looking to short the pair after the information on the daily has completed, and we will not be looking to buy it from here. Why? For the simple reason that we will not get many pips from that move, because the pattern is too small. So we need to have a W or information, then we need to have a good volatility, or in other words we can say good risk to reward. That means, in other words, big pattern. So the pattern has to be big enough, but if it will be very big, then it actually will simply be also a weekly pattern. So you will basically see the pattern both on the weekly and on the daily time frame. And in that case, we just go back to the weekly case, so it will be much simpler. So here on the daily, what you need to look, you need to see if you have a W or information on the daily. The pattern has to be big enough if you want to trade it back to the neckline. What do I mean? If you have an information and we want to long, as in the case of the weekly WM strategy, we need to have this pattern big enough to justify us taking this trade. So it means that inside of here we're getting at least a 1 to 3 risk to reward, meaning that this move it's a lot of pips. It's not like a quick 50 pips move, but it is a good amount of pips. In other words, in another way, if we get a pattern that is too small, then what we will do? If the pattern or if the market overall is bearish, so meaning if we're getting an information inside of a W formation on the weekly time frame, so the market is overall bearish, then this M pattern will become an ICI strategy pattern after the market has reached the neckline. So we will wait for the market to reach the neckline, and then we will be ready to take this trade with the ICI strategy. On the other side, if we're getting an information, and for example we have a big information on the weekly time frame, so again we have double confirmation that the market is supposed to go to the upside. So what this means is that we are getting a bullish, we're getting basically a bullish pattern inside of a bullish pattern on higher time frames. Then at that point we have two possibilities, two basically moments in which we should be taking the trade. You can either, if it is possible, take the trade inside of this area before the market reaches the neckline, and after the market has reached the neckline, you need to see a break of the neckline on the daily time frame, and then you can take the pair to the upside. Again, I will repeat it. If you have an information in a bullish market, then you can either look for longs before the market has reached the neckline. So we will go to the 4 hours, check for our momentum, check for our entries, and be ready to take the trade before the market reaches the neckline. But once the market has reached the neckline, you cannot look for longs until the market has clearly closed above the neckline with at least one daily candle, and at that point you can look for a long, because you know that overall the market is long, because you know that from higher time frames. And I will repeat again the other case. If overall you have an information in a bearish market, then you will wait for the market to hit the trend line and the neckline, and then you will be ready to take it with the ICI strategy that you have already either learned or you will learn very soon. So this is what we have for W and M formations. Now I made the example with an M formation, but it's the exact same case for a W formation. If you have a W formation on the daily time frame and this pattern is big enough that if we are looking for entries here, when the market gives us the entry in the 4 hours, this push to the downside to the neckline gives us at least a 1, 2, 3 risk to reward, then perfect, we take it. But if the market doesn't give us that, then we need to check higher time frames. We need to check on the weekly. What are we getting on the weekly time frame? Are we getting a bullish market on the weekly time frame, or are we getting a bearish market on the weekly time frame? If we're getting a bullish market on the weekly time frame, we will wait for this pattern to complete, and then around the neckline area we will be ready to take the long with the ICI strategy. On the other side, if the market is overall bearish, we will either take the entry before the market reaches the neckline, but once the market reaches the neckline, if we weren't able to take the entry, then we need to wait and see at least one candle close below the neckline on the daily time frame, and then we can take our trade in the 4 hours. So this is overall how you're supposed to approach W and M formations on the daily time frame. Now let's go on a couple of examples to show what I mean by this. Now obviously I will be showing 2 examples in which we have a pattern on the weekly time frame, on the daily time frame, we have a pattern on the daily time frame in which we have the possibility to take the trade to the neckline with a 1, 2, 3 risk to reward, even if it's a daily pattern. And I will be showing a case in which we don't have this possibility to take a trade with at least a 1, 2, 3, but what we do have is the possibility to take the trade after the market has broke the neckline, because from higher time frames we know that the market is supposed to continue to the downside. So very simple concept. Overall, this is extremely simple and straightforward, and that is exactly what we need in the market. Now let's see a couple of examples. Now I wanted to get something recent on purpose. Now as you can clearly see, the market here has created a W formation. Very simple pattern. I chose it on purpose because it's extremely clear. The market goes down, up, down, up. Very simple and clear W formation. At this point we're expecting a push to the downside. So what we should do is go on the 4 hour time frame and see if between the time that the market is here and the market reaches the neckline, if we are able to take a trade that has at least a 1 to 3 risk to reward to the neckline. So let's go and see what happens, but first let's identify our neckline, exactly 1.4780. Let's go on the 4 hour time frame and let's use our momentum indicators, our environment indicators. So everything is still bullish and the market has clearly passed below the trend, our neckline. So what you're supposed to do now is obviously you can remove the indicators, go back on the daily time frame and see if the market has already passed the neckline. And as you can clearly see, the market has already passed the neckline. So at this point, you need to check on higher time frames if the market was overall bearish. As you can see, we have a clear ICI strategy pattern in play here, so we are expecting the next impulse to the downside. So again, yes, we are completely bearish on this pair. And if you ask yourself to where we are bearish, if you take your trend, your Fibonacci's from the high to the low, you also have overall the target, the first stock number above the -27, which is 1.4480. So you have your target, you know that overall the pair is bearish on the weekly time frame, so perfect. We can now, since the market has passed the neckline to the downside, go on the 4-hour time frame and take our entry, exactly how I explained you above when I simplified the model with just some lines. So now let's bring back our indicators and let's see. So at the moment we are in a bearish environment. The environment of the market has changed from bullish to bearish. Everything is pushing down. So we need to see a retracement, because before the market shows us a retracement, we cannot take the trade. Now, as you are clearly seeing, the market has given us the retracement. Now, if we take our Fibonacci from this high to this low, you immediately realize that you have the 382 at this level. And you also realize that also at this level, you have this counter trend line. And also at this level, if you look left, you have structure. So this is a retest of a structure level. That is obviously a valid entry. You have your trend line, you have your counter trend line, you have structure, you have your 382. Everything is combining for a short. We need to check our numbers. We know that overall the market is bearish, but we need to check our numbers. Now you will have 1.4750, and obviously the slippage number of 50 is 65. So you will be taking your trade from this area. Now, taking the trade from the 50, obviously we expect a slippage at least to here. So our stop loss needs to be above. Now, first thing, we can take a very conservative stop loss. You need to realize that you have structure also around this area. So the market could go for a retest of this area and then continue to the downside. We need to leave air to our swing trade, because we also realize that we have a very big take profit all the way down here. So even if we use a relatively big stop loss, risking 1%, we are still risking 1% to make 4.5%, which is a 1 to 4, and which is more than what we need. We need at least a 1 to 3, and 1 to 4 is more than what we need. We can just take a clear 1 to 4, put our stop loss above structure. We have our 1 to 4, we will be perfectly fine. We only need to be right 3 times out of 10, and we are way in profit. We don't even need our indicators anymore, because we already know that the market is overall in a bearish environment. So we can keep our charts clean. We have our structure. Let's see what's happening. So as soon as we enter the trade, the market goes a little bit in our favor, but then it shifts back above. And now the market shifted to the downside, so rejecting our area. You can see very clearly the market hit the trend line and hit the slippage. As you can see, these numbers that I teach you are exactly very accurate in the market. The market stopped exactly at 65, which is a slippage number of 50. So as you know, the market first rejected the 50, then rejected the 65. Look at the accuracy of the numbers. Extremely accurate. So at this point, you are risk-free on the trade, because your market went down, made a retracement, continued to the downside. You can put your stop loss 1 pip in profit to cover commission, and the market just started the impulse to the downside, perfectly fine. Now, going back in time, let's see what other kind of patterns we're getting. Let's see if we have a pattern in which we have at least the possibility to have a big pattern and have at least a 1 to 3. For example, this is a very big pattern on the daily time frame. This is a very big M formation here in the daily time frame. So if you have a big M formation like this with a neckline here, you have the possibility to take the trade to the neckline. So you can basically take your entry for a push to the upside, because it's very likely on a trade this on a basically WM formation this big that you will get at least a 1 to 3. So it's very good to keep monitoring price action to take this trade for at least a 1 to 3. On the other side, if you have a small M formation like this, yes, you will get the completion to the neckline, but you won't get at least a 1 to 3. There is no way you will get at least a 1 to 3 in such a small range of price. So let's see what happened. I wanted to show you these two examples. One example in which you couldn't take the trade, and one example in which you could take the trade because you had at least a 1 to 3. So let's go on the 4-hour time frame, because here we have our information. So rule number 1 is satisfied. The pattern is big, so we need to see if we can take our trade and if we can take this pair to the upside. So let's bring back our environment indicators and let's see what's going on. At the moment, everything is still pushing to the downside, so we cannot take the trade. And this is the exact moment in which the market has shifted to the upside. As you can see, we have now a bullish environment. 10 EMA above the 20, MACD above the 0. So what you're supposed to do is obviously be ready to take your trade. You can also delete the indicators, because now you know that you're in a bullish environment. You don't even need them anymore. So what you need to look is where is basically the structure. You can see very clearly that the structure is here, because the market went up, retraced, and continued to the upside. So clearly we have resistance here, which is now support. The second thing you need to do, as usual, it's always the same things, guys. Always the same patterns for entry, always the same patterns for direction. What you need to do is check the numbers in the case of entry. You know that you have 80 around the area, and obviously the slippage number for 80 is 65. So our entry will be around this area. So we will take our entry on the 80. Now in this case, since the 80 is just a little bit below this resistance area, you can even put your entry a few pips above, even if overall the market will hit the 80. Most likely, most of the times the market will hit the 80. But in this case, since their support is a little bit few pips above, there is no problem in putting your entry few pips above. And obviously we know that the market, if it slips, it will slip inside of this area. It's supposed to stop either at 80 or inside of the area, or at most at 65. Now obviously sometimes you get some slippage even below, but you have already seen how accurate these numbers are. So our stop loss for sure needs to be below this area. Now in this particular case, you can also protect your stop loss with this low, because you see that the market went up, down, up, and now it's supposed to go down for a retracement before completing the pattern. So you can protect your stop loss by putting it below, few pips below this low. Why should I do that? Because simply if the market takes out my stop loss, it means that the market has created a lower low. So by definition, the market is not now in a bullish environment anymore from a structural point of view. And also our indicators will probably shift to the downside. So that is a good thing, because overall your job is to put your stop loss in a way that if it gets triggered, it means that basically the setup has failed. The setup in which you had the market structure in which the way it was has failed, and we have now a new market structure. So now we need to determine where is the neckline. Now in the case of the weekly M&W formations, if you remember, we would have put our neckline in this way, and then we would have taken the first strong number below. And that is exactly the same way in which you're supposed to do it on the daily time frame. And as you can see, in this particular case, when you put your when you put your horizontal ray on the close, so on the bodies, you get exactly 1.5080. So that will be your take profit on the 4-hour time frame. Your take profit for your trade, basically. So as you see, we are getting a 1 to 4 to our take profit. Let's see if the market triggers. So we already got filled on our order. The market went for the retest of the previous resistance, now turned support. Seems that the market is shifting to the upside, however it goes back below. Little bit of slippage below the 65, so we are now in a little bit of a risky situation. It seems the setup is failing, but our stop loss is placed below the low, so the market still didn't create a lower low. So if it now shifts back to the upside, we will be perfectly fine, also because the market created an information. So we have the possibility to go at least for a retest of the 80 here. So the market pushes above. Now this is a bullish pattern. I wanted to show you guys this. This green candle you see here is overall a bullish pattern. Every time you see a candle that looks like this, let me draw it better. Every time you see a candle that looks like this, the next candle will fill in the wick, and we have a high probability this of happening. And also if you see a candle like this, but on the other side is bearish, so if you see a red candle like this with a wick in this way, expect, actually the wick needs to be bigger, so basically the wick is bigger than half of the candle. That is the rule. The wick has to be bigger than half of the candle. How can you measure that? Simply by taking your Fibonacci from the high to the low and looking if by doing this the body of the candle is above or below the 50% fib, because basically the 50% fib will be half of the candle. So if you put it in this way, the 50%, if the body is above the 50%, it means that the next candle is supposed to fill in the wick. Very simple concept. So just something I wanted to share. So now I expect the next candle to fill in this gap, because as you can see, if we measure this candle, let's measure it, you're getting the 50%, almost, the market is almost 50% basically of the candle. The body of the candle is half of the wick. So the next candles fill in the wick, then we have another push to the downside, and now we are absolutely risk free. Our stop loss is now 1 pip in profit, and we are risk free on the trade. And now at this point, after such a candle, the pattern should complete and our take profits should hit, and that is exactly what happened, and we got our 1 to 4. So this is simply how you're supposed to trade the the daily W and informations. That is how you're supposed to trade the daily W and informations. Extremely simple concept. You need to look if there is a W information. You need to have at least a 1 to 3 risk to reward, and obviously the third rule, which is the same as the weekly W and informations, and is the exact rule that we just used. We need to have 4-hour valid entry. Very simple concept. And you know that our 4-hour valid entries are just wait for the momentum to shift in your direction by using the indicators, and then use the exact same patterns that we use for the strategies. So previous support turned resistance, like in the ICI strategy, W and informations, and a simple market structure, basically like trend lines. A trend line, a break of a retest of a break and retest of a trend line is one of our valid entries. So basically these 3 valid entries combined with market structure and momentum being on your side will give you very good setups using the WM strategy, both on the weekly and daily time frame.